So welcome new people who haven't been on the webinar before. A few of you have come from my beginner course. Welcome. This is something that myself and Ben, who is my Ben, and my lovely assistant is now doing more important things, but it's fine.
Are you cut out? I didn't actually hear what you said. Did you speak to me?
Yeah, I said here, for the new people, I said welcome. And this is a webinar that we both run, myself and my lovely assistant, Ben, business partner.
I didn't hear that bit because you went that we do often, and then it kind of went quiet, and then you went, oh, he's doing better things. I was like, did he talk to me? I presume that was aimed at me.
That was an epic fail, wasn't it?
Yeah, that didn't work.
So we'll get started. So if you've any questions, put them into the chat group here, and I'll answer them there real time. So it's as I'm going through stuff, I will ask you guys questions. So give me your opinion and what you think is going to happen next, and then we can go through it together. And I'll give you my assessment. And then after the first half an hour is up, Ben will jump in and he will give you a completely different way of trading. So some people like mine, some people like Ben's, some people like none of us thinks we're actually a shower of charlatans. But again, you have one or two people.
Nothing else to do on an afternoon. Say, wow, I'll just watch them two idiots.
Yeah. Okay, so we'll get started. So obviously the crypto market has taken a pretty big jump over since the interview all about the B word with Elon, Cassie, and Jack Dorsey. So we'll have a look here. So we've scaled into Bitcoin I've scaled into it on 3 different occasions on the way down. So the 23rd of the 4th, 17th of the 5th, and the 19th of the 5th. So we can see, even though there is only 2 days between the difference of these, there's a pretty big difference in the return on money. Why? Because in those 2 days, we had a pretty big drop in the market. So I got in at a pretty decent level. So look, my open price there was 42,000. Here was 30,000. So it dropped 12,000 in 2 days, which is a pretty big spike. Now we look at it now, the first entry is up 46 quid from £100. The next one's up 6 quid from 100, and this one is down 10% on 100. So the idea is to, as it's coming down, dollar cost average in as it's coming down. Now, a lot of people are like, oh, Henry, have I missed the boat? Should I jump in now? What's going on? And looking at this, do you guys think you have missed the boat at the moment, or do you think this is a good time to invest right now? What's your opinion? Miss the boat or get in now? Answers on a postcard, please. So jump in or we've missed the boat. So wait for a pullback, miss the boat. We need a pullback to at least a 42,000. Wait for a pullback, wait. Depends on the term. Miss the boat. Wait for a possible retest, 42,000. Get in now. Once pullback at 42. 42 sounds good. Pullback. Now, if long term. Okay. Now, this market is cycling. Okay. So we seem to have a phase 1, phase 2, and now a phase 1 again. Now, if we're looking at the likes of the candlesticks themselves, look, we have a high test bar. So it tells us that the buyers are going up, and then the sellers took over. We have it opens here, it went down, and then the buyers hit the 42,500, and then the buyers took off, and then the sellers jumped in here again. So today, it's telling us that it opens here, the buyers push it up, and then the sellers took over. So there's a huge argument here between the buyers and the sellers. Now we're in a phase 1, we've made a higher high. Now we're expecting a phase 2 here. We're expecting a phase 2. Now, what drives the likes of this is hype. Now, if we're looking at this, see the likes of this bar here. This is the kind of bars that we're looking for. This one here that we have huge momentum. There's loads of buying power. See this one here? That just loads of buying power. We're looking for these big bars here driving it in a particular direction. And that's what we're looking for when we're looking to trade. Now, if we look at the likes of this move here, see how big this move is, and then we had a phase 2. So this move here And again, this one here, look at the size of that momentum. And again, on this one, look at the size of that momentum. So if we come back over here into this one, we're not sure yet. People are still a little bit uncertain whether this is the best time to buy or not. Yes, we have upward momentum, but I expect a phase two. Now, personally, I would expect it to come back into this and have a double bottom there. I don't think 42,000 here is a strong enough level to hold it if it starts coming back now. Okay, there's a bit of a double bottom there, and technical analysis is pretty important when we're starting to get these moves to take off. But for it to come back and respect this 42,000, it would have to go up a little bit higher for me. It'd have to go up to somewhere about 50,000 and then come back. Why didn't that stay? Oh, or it's not letting us stay. Bear with me to refresh this page. See, will it stay now? So for me, it has to go up to about the 50,000 for me to be actually looking at it in a little bit of detail. So for me to be expecting it to hold at the 42. Bear with me, make it nice and thick. So up to about the 50,000. And then if it pulls back, that's where I'll be looking to jump in back around here in this area. Now, if you're a long-term trader, you can just buy that now and hold on to it. If you're someone who's expecting a phase two to come back to here, then you just sit tight for another little while. Okay, so it depends on what type of trader you are. You could buy it here, and if it drops back down to there, buy it again. But the idea is we're not going all in with every bit of our funds. We're jumping in strategically at points that make sense to us. So for me, as a technical trader, I would never jump in here because we're part of this phase one. I would wait for that phase two. Now, whether it comes back to the 42 or whether it comes back here to the 37 level, only time will tell. But if it starts dropping now, I wouldn't expect it to stay at this 42 level. I would expect it to break it. But again, only time will tell. And that's the beauty of technical analysis. But this could be the very, very start of the next bull run. Let's see if companies start incorporating it properly into their sales. And if they start incorporating it properly, then this could easily break the 64K. But it comes down to good news. We have to have good news on this. So ADA, anyone who held ADA has just received a staking, which is pretty nice. Well done, anyone who got free money. Now, what a staking is the equivalent. It's equivalent to a dividend. Okay, it's equivalent to a dividend. So if you hold on to a certain amount of ADA, you get a staking, and it means then that they give you a little bit of money to say thank you for holding on to it, for the transaction fees, all that sort of stuff. So that's where it comes from. Okay, now, as you can see here, my entry was here and I didn't get triggered in. I put it on somewhere else here, and there's 1, 2. Because of the spread, I didn't get triggered in, which is massively annoying. I'd be up 50% now on that particular investment if it had triggered me in. But again, you live and die by your sword. So that order will stay there. It is finally broken through this level again. And it is pretty similar to the likes of Bitcoin. I need that to continue. I need that to continue up a little bit higher, up to about the 1.7, and then retest. And then retest back down into this area. If I retest down there, that's where I am looking to jump in. But at the present moment, that is not something I'm looking at the minute. So let it sort itself out. And I don't know whether you can see that. eToro's charts are glitching, so it is flashing at me. It'll change now in a second. Or because I've highlighted it, it probably won't. There we are. Look at that wick. We got a wick changing. So there's a little glitch on the eToro chart at the moment. We had the same on AHT yesterday, and I raised it to them, and I said they would look it up. Ethereum is something you guys are heavily invested in as well. And you love the little Ethereum hype as well. And the same happened here. So anyone who jumped in on this trade, well done. You were massively up. Anyone who got that on leverage, Anyone got that on leverage? So entry there, stop loss there, which is 12%. At this present moment, you are 68% up. So 6-1, just a little bit over 6-1. Well done, or just under 6-1. Well done. Anyone who did that. So keep up the good work. And the same here. It has to go up a little bit more and then come back. But we are expecting a phase 2. So if the phase 2 happens here, I would expect it to come back into, say, this area, which is the 2,390 or 2.4 level, and then potentially look for it to bounce. But if it goes up a little higher and then we have a phase 2, I'll be looking for it to jump in there. Anyone who wants me to look at any particular crypto, pop it in the group there. And I'll have a look at Matic. Oh, that's not Matic. So Matic also has had a little bit of a jump, but nowhere near as big as the other two that we just looked at. And there's no real structure. We have a small level here, but it's not something that is, it's not a strong level. There's not a dramatically jumping out here. So this looks like the beginning of the next bull run, but let's have a look. Link. Chain link and not China link, as I once called it. So China link was a little bit more difficult to understand, as it didn't stop at these levels. It broke through it, and again, it's now made that higher high. But if we're looking at this level and then this one, the next entry on this would be, or using technical analysis, would expect it to come back into the likes of this area here. So anyone who is bought into any of these cryptos, there's loads of upside in these at the minute. If Bitcoin takes off, there's loads of upside. There's more upside on the likes of these than there is in Bitcoin. Why? Because they're much cheaper, which means the percentage jump, or the amount of people investing in them, you can have a 200-300% jump very, very quickly on the likes of these. So these are similar to trading stocks with leverage. Why? Because they move so quick. You have Bitcoin, which is the normal stock, which would be underlying asset, and then these altcoins would be the things with leverage. So that's the way we sort of look at them. When Bitcoin jumps 10%, you get these jumping 20 to 50%. Okay, so just be aware of that. Trade that we looked at last Tuesday, AHT.L. Sorry, AHT.L, is it? There it is, AHT.L. AHT.L. Okay, so this is a trade that we looked at last week. Now, people ask me all the time, Henry, how do you pick out trades? How do you come across trades? Now, I have never seen this stock before last Tuesday. Last Tuesday was the first time I saw the stock. It was on the webinar and was looking at this, and look at the overall trend. Look at the momentum, look what's going on. This is what's happening. I then put in my trend line, bounce, bounce, bounce. We have a horizontal support, resistance here, and entry, stop loss. And this is all I needed to have a look at this particular trade. And that's all I needed to jump into this. Now, at the moment, we have a little red bar here today. But if we look at the particular trade that we took, look at it, risked 100 quid. At the minute, we're 100 quid up. Now, it depends on what type of trader you are. Now, for me, I'm looking for a 3-to-1 on this particular trade. So which means then my target is 300. Now, I will let that run, or it'll hit my stop loss. There's no in between with this. It's going to hit one or the other. But if you're someone who is a little bit nervous or has a nervous disposition, you can close this. You can par close this. You can edit the trade. You can do as you see fit. And for the new people, how you would par close this trade is you click on the X button here, par close, See the par close here, par close this trade. And it's telling us that I have £1,092.66 in the market. It's telling me it's closing half of it. So which means theoretically that if you have 102 quid in it, if you par close that, you're banking 50 quid. And then you would click on par close. And then the last thing I would do is I'd get my stop loss and I'd move that into plus maybe 5 or 10 quid. Okay, so that's what I would move it, moving in potentially 5 or 10 quid. So that's what I would do with that particular trade. But that's how I see trades. That's how I pick them up. People always ask me, Henry, how did you come up with this trade? You guys, let me know. You guys tell me. You guys are looking at particular charts. You are looking at the particular markets, and then for me, it's just literally. It is literally when you guys say it to me, like, and that's the idea of these, and that's the idea of this. It's getting there. It's following the process, having 2 sets of eyes, and then with an extra pair of eyes, then we can see the markets, and 2 heads are better than 1. Okay, and that's something we need to be doing, and that's the idea of these webinars. Anyone want me to look at anything in particular? EGO. EGO, I wouldn't touch it with a barge pole. I'm assuming you're looking to buy it. Bluebird, it's a nice restaurant in Chelsea. If you're looking to trade that short, potentially back to that level, and if it hits that level, then short the market. Back to there, potentially shorted, but no, it's not something that I would be looking at. I hate there last week. Bubbles, you never give me a shout. Have you looked at copper? Nope. Yeah, copper has continued to drop. Copper has continued to drop, which is massively annoying. Which we were up 2 to 1 up at one stage, and it's back in this area, so which is massively annoying. You either now have to jump out of it or sit through it. But again, these highs are still higher. That's the takeaway here. The high is still higher, and it is massively annoying that we were up so much money and now it's come back into this area. But the reason this has dropped is because of what's going on in China, and that's the problem. And that's why, with all the uncertainty about the stocks in China, what's going on, the variants over there, the coronavirus, all that sort of stuff, and that's why this is dropping. And look, only time will tell. That's the problem. We don't know where the end of this is, but we do expect it to pop to the upside at a certain point. But whether it'll drop us out or not, we don't know. Berkshire Hathaway. This is one of these investments that we sort of should have in our portfolio, whether it's an underlying asset, whether it's a CFD. It's one of those ones that we pretty much should have in our portfolio. I know Ben talks about this quite often, but we've had a breakout. Ben, would you rather go through that and a breakout with and then add a little bit of fundamentals to that one?
Yeah, I can go through that in a minute if you want. Yeah.
Yeah, cool. That would probably suit a little better. But yeah, with this breakout trade, for me, we've missed the boat. I would like a retest on that, back to that area for me to trade it. But Ben will show you how he trades the sort of breakouts. And it would make a little more sense. But for me, I have to have a retest there. Bluebird. Chart. Again, this is something I wouldn't touch with a barge pole. Okay, okay, so the likes of this here, Bluebird, unless you know some insider information, unless you know something that we don't know, Carol, and the same with, what was the other trade? Ego, unless you know some sort of insider information, this is not where you should be putting your money. So look at the trend here. This is going down. So if you're looking to short this, absolutely, while it comes back up to this area, short it, press the sell button, jump in on it. Okay, but if you want to jump into the Bluebird, go to Chelsea and have some food there. You're better off, money's better spent in that than the likes of this one. But see the difference in your trend. Your trend is going down, it's depreciating, the value is going down. And look at what I'm trading. So AHT chart. Look at the trend. Which one has the higher probability of making money? And that's all we're looking. That's all we're looking for. We're looking for the opportunity to make money, and this one has more opportunity to make money. Now the other one may turn. The other one may turn, and the idea of Bluebird is I would wait for it to turn. I would wait for this market to turn to the upside before I would jump in on it, because even if you jump in at $30, look where it was previously. It was up at 230 at one stage. So there's loads of room for this to go. If it turns, there's no point in trying to catch the very bottom of it. Just let it turn and then jump in on it. Visa is something I have been in a long while. I think about a year and a half now at this stage. We took it on one of the webinars. We're 43% up. And this is just a trade that is nicely chucking along. It's just nicely doing what it should be doing. It's had a nice little pullback. And again, this is the types of charts that I look at and I trade, is the likes of this, where we can try to anticipate what's going on. Get a trend line underneath here, and we can start potentially anticipating the bounces. Now, I understand that this bounce has come back a little bit further, so there's a potential double bottom there. Okay, it didn't bounce off that previous high. It came back down a fraction lower, so we probably wouldn't have got that one. Our trend line would have been there, but again, look, bounce. So what we can do, if this continues to take off to the upside, we can drop down to the 4 hour. We can drop down into the smaller time frame and then wait for a phase 1 and phase 2. So by using these two highs here, what we would look to do is segment this high and this one, bring this across. And what we look for is a phase 2 on the smaller time frame, down to potentially about there. So the lows are getting higher, come back in this area, and then potentially look for the phase 1 to the upside. So I wouldn't be looking for it as a day trade at the minute. Obviously, I'm talking about CFDs. If you're looking to buy this as an underlying asset, absolutely, we're pretty early in the phase 1. Just buy it up and sit and hold. MU, please. I thought that was Man United. I was going to say nope. This one is a little better than the other ones that we've looked at. We do have a horizontal. There seems to be a bit of a floor there at this particular point. So bounce. We have this sort of double bottom here. But again, this would be something I would take as an underlying asset. This is not something I would take as a CFD trade. I might even wait for this to come back down. The structure of this tells me that this is still going to come down to there. And it failed to take out this high here. So these two, see these two highs? I failed to take out those two highs. Of having two red bars, I would fully expect it to come back down to here and then bounce. So I potentially put an order in there at $75 if you're looking to buy this, but this would be an underlying asset rather than a CFD. Levi was one of those ones that done well after their IPO. Well, shortly after the IPO, dropped like a stone and now has taking a pretty big jump to the upside. We do actually have a horizontal level there looking at the previous data. Obviously, this is pretty new to the stock market, so there's not a huge amount of data on it. But again, it would, for me, come back into this area. If it comes back into this area, then potentially as an underlying asset, I wouldn't be looking to trade it as a CFD. Why? Because it's made at a lower high. This looks like the bend at the end. We could see a consolidation happening here before that pops up to the upside. Turn your screen upside down and you're sorted. And WTI, so oil. Chart. So oil. Now, on the Tuesday, on the Sunday webinar, we talked about oil. I'm gonna get rid of all this sort of stuff. Okay, now I get rid of that. So we have a level bounce. We've had this double bottom. So guys, what's the trend here? And I want everyone to participate here. I don't want some people answering. I want every single person. There's a good few people here online. Every one of you. What's the trend here? So down, south, down, down, down. No trend. No trend, channel. Come on, that's only about 10 people. I'm going to go against and say up. There's always one, isn't there? There's always one. No trend, double bottom, up and double bottom. Okay, so if we're looking at the market, we have a phase one, phase two, phase one, phase two, phase one. Now, we don't know whether this is going to bounce the upside, but what phase is that in? In a phase one to the downside, isn't it? We have a downward trend. We have a downward trend at this present moment in time. So bounce, bounce, bounce. So is this something we should be trading? Now, I assume everyone is looking at this as a long position. Well, we have a horizontal level there that it bounced once, twice, 3 times, 4 times. Look, and because of the wicks there, we can class this as a bounce. It's right on the open and the close. Okay, so we have that there as well. But this is a downward trend. Now, if you zoom out, you say, well, Henry, the overall trend is up. Overall trend is up, which it is. Now I'm going to delete this here and I'm just going to show you the higher time frame. Now, the idea is we never trade the lower time frame, which would be the daily here, when the higher time frame is in a phase 2. So let's have a look at the higher time frame. Now, what phase is the higher time frame in? So if we draw these in, we have a phase 1. We have a phase 2. We have a phase 1. Phase 2. Phase 1. And then we have a phase 2. Now, if you want to trade this, you should be trading this on the weekly chart. You should not be trading this on the daily chart. Why? Because the weekly is in that phase 2. So our entry has to be above it, our stop loss has to be below it, but we are looking to trade this on the weekly chart. There's the entry, and then a stop loss would have to go below here. Why? Because this is a daily phase or weekly phase 2. And that would be the weekly trade, and you'd be trading it back up to that level. But if you drop down to the daily and you try to take that trade, where's your stop loss call? Where's the entry? Okay, because the idea is this may pop up and just continue, because remember, we're in this phase 1 to the downside. How strong is this level? How strong is this double bottom? So make sure that when you're trading, you're getting in at the correct times rather than just trying to trade. There's much better charts out there to trade than the likes of this. But again, I wasn't confident of this bouncing to the upside, and I was wrong. It was. I told you guys when we were on the webinar, this probably won't make a double top. I was correct. So again, we're correct and right all the time, but it's comes down to your perception of the market. This is not a trade I would take for the reasons outlined before. So Ben, is this a trade that you would take? And I'm just going to pass you over to Ben.
No, so it's not something that I would probably personally take. The problem is, obviously, with something like that, guys, what you have to take into consideration as well, you're executing that as a CFD. Now, obviously, entering it from a weekly setup, essentially, you're probably going to be in that if it runs nicely for months, right? So for me, I feel like it's probably not going to be the sort of thing that I would like to take, for the simple factor that your commissions and stuff like that are going to start adding up pretty quickly, because you're going to literally be holding a CFD position for months and months. Of course, depending then on your view and depending on what sort of reward you feel you may be able to get out of it, then obviously you have to take that into consideration as well. So what I mean by that is, if you genuinely believe for some sort of solid fundamental reason that oil could make a big, large run to the upside now and end up, rewarding you with, say, like a 5 or 6 to 1, it's then obviously worth holding on to for a handful of months. That doesn't mean that you just slap a 5 to 1 target on it, though, because obviously the chances of it actually getting there, if there is no valid reason, are nothing. So you have to obviously weigh that up. And then, like Henry said, with the daily chart example there, obviously we've got the lower high, stuff like that. So obviously it doesn't really kind of give you the appeal there. So just with setups like that, guys, make sure you know what you're trading firstly, know what the expectations are, and make sure you take everything into consideration would be what I would say there. But what I want to do is I want to jump on to, if I remember rightly, a second ago, it was the Berkshire Hathaway B shares that you pulled up. And you wanted to discuss the potential breakout there. Is that right, guys? Was it Berkshire B?
Yep, that was correct.
It was Berkshire B, wasn't it? Right. Yeah, cool. So here's the way that I look at breakout trades and the way that I personally trade them. Okay. So the first thing is you always need a valid consolidation pattern. This is the first thing that I normally see people make a mistake of, right? Just because it breaks any old trend line that you've drawn on a chart doesn't mean it's a breakout, right? The amount of times that I've seen people do that, there might be something that's trending down like this, for example. It then suddenly pops its head above and they're like, oh, I'm taking it on the breakout. That's not a breakout. It's just broken a trend line you've drawn on. A breakout is when you've had a period of consolidation prices and tightened up essentially and squeezed up, and then it breaks out of that consolidation. What you're doing when you're trading a breakout is you're trading momentum. Now, if it's just any old trend line, there has been no build up of buyers and sellers and stuff like that. There's no consolidation beforehand. Think of it like a loaded spring. You need to have some sort of compression before you're then going to get an explosion the other side. If you've just got any old standard trend line and whatever it pops its head above, it's going to have no bearing to it. Now, if we take a look at Berkshire B, for example, we can clearly see that we've had this consolidation period there. Can we see that? And we can see the way price is squeezing up. Can everybody see that if I've drawn that on there? What sort of pattern would you say that's called, guys? What's the name of that pattern, please? So the pattern I've just drawn onto that chart there, what is the name of that pattern? So I've only got one answer so far. I'm going to wait for you, to a bunch of you to answer. Don't be scared of getting it wrong. The whole point of these sort of things is that you can learn. If you don't know what it is, just say you don't know what it is. If you think you have an idea.
Is that a chimney?
Yeah, the chimney pattern. So a couple of people got it. So this is an ascending triangle. Okay. A couple of people have got it mixed up with a wedge. The difference with a wedge is you get rising and falling wedges. So a rising wedge would be like so. So you have higher highs and higher lows still, but we're narrowing in like this. A descending wedge is then obviously the opposite. So it's when the price is narrowing in. We've got lower highs and lower lows still, but we're squeezing in and narrowing down. And both of these patterns, wedge patterns, would be classed as reversal patterns. The reason for that is because the narrowing is caused by each phase one that we have within trend getting shorter. So the idea being that the buyers or selling momentum is running out. Okay. Now, when we're then looking at a triangle, which is what we've actually got here. So this is an ascending triangle. This is where we have a flat top and some sort of higher lows squeezing up against it. So remember we said, imagine that sort of spring effect. We've got that squeezing against the resistance. So the opposite of that would, of course, be a descending triangle where we'd have a flat bottom, the lower highs then, and we're then squeezing against it in that fashion. Now, what we would anticipate, generally speaking, is that we break in the direction of. So i.e., if it's a descending triangle, we would expect and anticipate a break to the downside. Why would we expect a break to the downside? Because we're still getting lower highs. And each time the buyers try and step in, i.e. offer support, they don't have the momentum to reverse the trend. The opposite is, of course, then true when you're then looking at an ascending triangle. You've got the flat top, which price is sort of popping its head against, but then we're getting the higher lows because the sellers aren't able to reverse the trend. And we would therefore expect to see a breakout to the upside. Does that make sense to everybody just before I carry on? So that's the first bit I want to discuss there. Just give me a yes or a no, obviously, if it does or doesn't make sense, please. Yeah? Okay, perfect. Now, what we have to be careful of here is, remember what we said, when we're trading this type of pattern, what we're looking for here is we're looking for an explosive move afterwards. Therefore, there has to be some form of reason as to why this would go higher. What would make a stock go higher? Well, of course, there can be various fundamental reasons and stuff that we can discuss. But essentially, in order for this stock price to move higher in any way, shape, or form, it's going to need some sort of volume behind it. Now, when you're trading a pattern, it's more technically based than fundamentally based. So let's say you was buying company A shares and there was a fundamental reason behind it. You don't need to see the volume and everything coming in. You probably wouldn't even be trading an actual technical pattern to begin with. You're buying it for a fundamental reason behind in the business for a long-term investment. When you're trading an actual chart pattern and setup like this, you need to make sure you've got volume and things coming with it, because obviously you'll be getting out if this pattern fails. So let me just draw this on in different colors here, just so I can kind of break it up. So if this is our pattern here, okay, at what point, so if I decided to buy this stock today, let's imagine I bought this on the open for argument's sake. Where would my stop loss go out? What would my stop loss go? Sorry. What would make this now invalid, do you think? So if I was buying it today, I want to know where to get out if I'm wrong, don't I? So where do you think my stop loss would have to go, guys? What do you reckon? Don't worry about getting it wrong. Just give me what you think. If I bought a stock on the breakout, Don't have to give me a price. It's more a structural thing. Yes, we've got a bunch of answers coming through. So there's essentially two places you could put it in. It all depends on how sort of cautious you want to be, okay? So option number one is what we'll call it, is beneath the most recent low pre-breakout. So that would be this low here, okay? So we can put it beneath that low. That's our first option. Now that would be what I would say is a slightly more aggressive stop loss. Now, I wouldn't put it just underneath the horizontal, because at the end of the day, this stock could easily retest. Remember what Henry said. He always likes to see a retest of those levels. Now, we also know that horizontal levels, support and resistance, they are not an exact science. They are not an exact figure. They are more zones, right? So if this stock did test and retest that what was resistance now as support, there's every chance it could pop its head just underneath for a brief moment, right? So we don't want to put in the stop loss right underneath that, because it's not going to hit it perfectly. It might do, but there's every possibility it will dip below, stop you out, and then carry on, right? So what we want to do is we want to put it underneath that low there. So let me just zoom in a little bit more, actually, so you can see that a bit clearer. So I'll just draw that back on. So we've got obviously the resistance, the higher lows. So we would put that underneath, just put the red again, underneath this low there, okay? Now, the more conservative stop loss, option number two, would be to go under the low before that. Now, there's no one method is better than the other. You can argue one would be better than the other on some occasions and vice versa. There will be times where the market may have a more extreme retest and it might pop itself down, dip just underneath that low, and then carry on. And then you've been stopped out and it continues. It may also always carry on all the way down here. So there's an argument where, well, this was better because it obviously made you lose less. But obviously, if it stops you out and carries on, it's going to feel crap because it feels like you've been stopped out of a trade you may still be in. Obviously, the downside with being down here, if you go the more conservative option, don't worry about the stock for now. We're talking about the pattern, okay? The more conservative option, so stop number two, the lower one, obviously gives you a little bit more breathing room, but the downside is it's then going to obviously take a little bit away from your risk to reward ratio. So there's pros and cons to both. It will be purely a personal preference as to which you're more comfortable with. Would you rather give the stock a little bit more breathing room and just accept that it's going to eat a little bit into your risk to reward? But obviously the plus side being that sometimes you'll still be in a stock that others might get stopped out of. Or would you prefer to be a little bit more aggressive with the stop loss, increase reward to risk ratio, but then it may be a situation that you get stopped out every now and again, okay? So that's the first thing that I want to cover when it comes to breakouts. There must be a clear exit point. And this is always the case whenever you take any kind of technical setup. There must always be a clear and defined exit point, and it must be there for a reason. One of the things I always see people do, and it makes no sense, is they go, right, I'm X% up, I'm 1% up. So what I'm now going to do is move my stop loss up to my entry. You're just literally putting it at a random place, right? What you'll notice is, for example, when Henry's managing a trade, let's say he gets, 2 to 1 up, he'll park closer position, but he's not massively moving the stop loss unless there's reason to, right? So i.e. underneath higher lows and things like that. So if you want to secure a little bit and take a little bit off the table, put a little bit of money in your pocket, you can park closer position if it gets up 1, 2, 3%, whatever your sort of rule is. But when your actual stop loss placement, there must be a valid reason for where it's going. Now, of course, the obvious thing is if a stock is trending, well, then you, of course, put it up underneath each higher low, because then it's only if it breaks underneath that now is no longer valid because you've made a new lower low, right? So same thing when you're getting into the trade. If you've got the setup there, you're going to go underneath one of the lows because at that point, the pattern is no longer valid, all right? Now, once you know obviously where you want to get in and obviously where your stop loss is going, there must now be something that validates you actually pulling the trigger. And we spoke about it a minute ago in the sense of volume, okay, and the momentum. Now, you can get it on pretty much any charting software. I don't think you can get it on eToro, but of course, eToro is predominantly a broker. It just has a charting aspect on it. But if you get anything that's specifically charting, you will typically be able to add volume. So maybe you use TradingView, or you might use TC2000 like me, or Stockopedia, or whatever. And you'll be able to add volume. And all this is simply doing is telling you how many shares are bought and sold. And generally the colors are going to be green or red. And obviously if it's red, then there was more selling than buying. And if they're green, more buying than selling. Because we want to see now the stock carrying higher, we want to see an increased amount of buying volume. Okay. So what we want to do here, guys, is we want to see, right, we've had the breakout pattern. I've decided I want to buy it here, for example. I've decided that I want to use this low as my stop loss. So I know where I'm getting in. I know where my stop loss I want to go. I want to make sure that there's more buyers around now to take this stock higher. So what we would do is we would look at the volume gauge down the bottom, and we're looking for an increase in buyers, i.e. we want to see a bunch of green buying bars that are a decent amount larger than previous bars. I want to see increased amount of buyers coming into this market to now take this stock higher. If they are not there, it is a lot lower probability that this stock is actually going to move higher, because why would the stock go any higher if nobody's buying it? Doesn't make any sense, does it? Now, what I typically do when you look over here, I actually add a moving average onto my volume. And the reason I do that is it gives me a bit of a gauge for the average sort of volume for the stock. Now, I use the number 60. Anybody want to guess why I use the number 60? Why would I want a 60 moving average on my volumes? Anyone want to take a guess at that? What would it be showing me? Anybody want to have a stab in the dark? Yeah, it's it's the number of days, because it's on a daily chart. Correct, the last 60 days. What's relevant about the last 60 days, do you think? It's not 2 months. Because how many trading days are there in a month? There's not 30 trading days in a month, are there? Correct, it's a quarter, right? It's 3 months basically, because average month is 20 trading days. 3 months of that would be, so 3 times 20 would be 60, and obviously 3 months is a quarter. So it's showing me the average for the most recent quarter effectively, right? So it's giving me a decent sample size. I don't want to do it just compared to purely yesterday, because individual days can be random. I want it over an increased number of days. So I use 60 as the average there as a bit of a visual aid basically. And if I see the stock price, let's say for example like this back here. Actually, you might not be able to see that red. Let me make it more obvious with the yellow. So see like back here, we had it jumping over the 60 there. We can see that there's more volume in that day than there has been for the average for the most recent quarter. Same as like back here and things like back here and stuff like that. Now we can see here, and you can even really see it compared to the most recent bunch of candles as well, that you've got, apart from 2 days ago, which is only barely, the volume is pretty much the same as it has been. Now, why would that be a concern? Well, look what happened during this period here, and then look at the volume during that period of time. Why would the stock go any higher all of a sudden now if there's no more additional buyers than when the market was going sideways? Can everybody see that? There's no real reason, is there? Think about it. All this volume in buying and selling that's going on has not been enough to move the stock. It's gone sideways for a good month or so. So why would the stock suddenly go up 10, 20, 30, 40% or whatever from here if there's no more extra buyers than there was before? There's no real valid reason. Could the stock go higher? Well, of course it could, because you might end up with some really thin trading. And so the small amount of buyers could actually send the stock higher. But it's not very likely. What you want to see is an increased amount of buyers. So let's go to Google, for example, right? Let's look at a couple of times where we've had an increased amount of buyers. So let's go, for example, let me just move this back a little bit. Let's say like here, right? We had a nice bit of consolidation. The stock breaks out. So we can see the stock breaks out here. What do we notice about the volume down the bottom? Has a big increase. Can everybody see that? No, because you're now looking for things going forward. So the volume is taking it out of the consolidation, but you need to see more buyers there to now carry it on going forward. If you have no additional buyers to take it higher, then there's no reason for it to follow through. So what we're looking at here, for example, look, see how we've got the consolidation pattern. The market was going sideways. We then break out. Notice the increase in volume at the bottom. Can everybody see that? Same thing over here, right? Market's consolidating. We then get an increase in volume as the stock then breaks out and goes higher, right? That's what you're going to be looking for. So if you're ever trading the actual breakout patterns themselves, I think Facebook did it a little while ago, if I remember correctly. So we have long period of consolidation here, price squeezing for a while. When it finally breaks out, look at the increase in volume down the bottom. If you're trading breakouts, you need now momentum to carry the stock higher. I think Tesla even did it a while back. Yep. So look, we can see it here. So let me just zoom in. Same thing. Price consolidating for a while. Stock finally breaks out. What do we have down the bottom? You can see the volume. Look, big jump in the volume. Look at the volume here, guys. So let me just erase everything from this screen. Now, look at the volume that's going on here during the time that the market is consolidating. Can everybody see that? The volume is just drifting lower and lower and lower. Let me actually put an arrow on it. You'll see it even clearer. Notice down the bottom here, the volume's dying right off. So it's not a surprise that the market's consolidating because there's no buyers or sellers in here, right? So of course the market's not going to go anywhere. Then all of a sudden we get a breakout. Why do we get a breakout? Because the volume's increased. There's now more people now buying this stock, so therefore the stock can go higher. Therefore, we get a big follow through to the upside. Does that make sense to everybody? It's quite logical when you think about it. I want the stock to go higher, therefore I need more buyers than I had before when it was going sideways. There's not more buyers than when it was going sideways. Why on earth would the stock go higher? Of course, it can do in rare instances when there's thin trading volume and the little volume that there is buying volume. But what you've got to look at is, well, what's the probability here? Remember, everything that you do in your trading is all based around increasing your probabilities, guys. The amount of times I see people in the chat room and stuff like that say, oh, yeah, I know I shouldn't really be in this trade, but I've decided to get in it anyway. And then they wonder why they're sitting there losing money. Like, it's not rocket science. You're doing things you're not supposed to do. You're not going to make money. You've got to follow basic rules. If you do not follow basic rules and you're just trading for the sake of trading, do yourself a favor, close your trading account down, go to the local casino. It'd be more fun. At least you'll have fun losing your money, right? So if you see a large volume bar, it does not mean that you have missed it as long as you get it. You know, you've not missed it. This is what the point I'm making here. The market's going sideways. Why is it going sideways? Because there's no buyers or sellers. The only way it can now go higher is if I start to see more buyers come in. So therefore, if the volume comes in, as we break out, we are happy to be buyers of it. This is now showing me that the buyers are there. The stock has a valid reason to break out of that pattern and therefore has valid reason to carry on. There is no guarantee, right? But if you're going to trade a breakout, there has to be buyers over no buyers. The probability is much greater. There's no such thing as a surefire thing here. Any patterns that you trade are typically only going to be about a 50% success rate anyway. So what you've got to do is you've got to have as much in your favor as possible. If you don't, well, then you've got absolutely no chance. Even when everything is lined up in your favor, only about 50, 60% of the time will the patterns actually play out. The difference is that when you then do it correctly, you're making a lot more than what you're losing. So therefore you have a winning edge over time. Does that make sense, guys? Just give me a little yes or no, please. It's all about probabilities, okay? So when you're taking those breakout patterns, you have to make sure there's actually some buyers there to actually take it higher, which if you think about it, is very, very logical, but it's something that a lot of people don't look for, all right? So make sure that you are always keeping an eye on that. For something like Berkshire B shares that we're just talking about there, for me, the volume is basically exactly the same look as it has been the whole time this is going sideways. Does that mean it can't go higher? Of course not. But does it mean that it's low probability? Yes. I don't know about you, but I don't want to put my money on the line for something that is low probability. It's as simple as that. I'd much rather put it into something where there's higher probability. To me, that's just good logic. All right, guys. So yeah, let me know obviously if that makes sense to you guys. If you have any examples and you want to pop them into the chat room there and stuff like that, and you want me to kind of double check it and things like this, by all means, please do if you find any. But make sure you are keeping an eye on that. Those of you that haven't yet checked your inbox, make sure you do. Anyone that's gets my free weekly stock reports that are sent out every Monday. I sent it out last night. In case any of you guys have never seen one of those before, it looks a little something like this. So every single Monday, I send out a free weekly stock report. So it'll give you a breakdown of the company. So obviously yesterday's was Uber, breakdown of the profile of the company, what they do, a bunch of analysis, etc. See my views and everything in it, and a little bit of a chart there. Completely free every single Monday. I'll send you the link here. If you haven't all you need to do is literally put your email on the list and you'll receive it every single Monday. If it is already on there, then obviously you don't need to add it again. If not, hit that link, pop your email in the box, and then you'll get it every single Monday. So I do different ones each week, and you can always request stocks as well. So make sure you do that. All right, guys. But outside of that, unless Henry's got anything that he wants to finish off with, that is everything we need to cover. It's 2:00. Is there anything you want to touch on before we go?
Going to just show them trader stream. Anyone who wants to jump in and board?
Yeah. So if anybody wants to take advantage of the webinars and that myself and Henry do each week, so we do like 3 or 4 webinars a week. We actually have a couple of crypto webinars here and there as well. Get rid of that. All you need to do is literally go to the website. If you've never been a member before, you can get your first month completely free as well. Oh, I didn't see you sent that already. Get your first month completely free. So come and give it a try, guys, to get access to the private chat room where me and Henry take place, post all of our trades as we take them. We do obviously the webinar showing you exactly why we're taking them. It's literally complete access to us and our trades. And you can try it for 30 days completely free. If you don't want to carry on after that, you don't have to. There's no obligation to. All right. So give it a try, guys. Outside of that, we will, of course, catch up with you during the week. And I'll wish you all the best for the rest of the trading week. All right, guys. So take care, and we will see you very, very soon.
Thanks, everyone. Bye-bye.